Hello friends, in the last video we figured out what delta, vega, theta and gamma Greeks are. That's great, and we can start learning about option strategies. But there is something very important we need to understand first, specifically the margin requirements for securing open positions. And it's margin requirements that I want to focus on in this lesson. Options trading involves high risk, and where there is high risk, there is a high profit. But unfortunately, there is also the possibility of incurring a significant loss. It is necessary to clearly understand how the margin requirements for options are calculated in order to gradually add margin requirements to your trading account to keep positions open. If we're talking about futures, on the AE exchange, the margin requirements are 20%, 1/5. With options, it's a little more complicated. Margin requirements for open positions on futures and options, let's say on the basic asset of Bitcoin, they are summarized. Positive risks are taken into account, and what I like to call portfolio margining is used. Generally, the combination of options and futures reduces the size of margin requirements. If they were separate, the margin requirements would be higher. One more important point. When you open positions, when you place orders, the orders do not take into account the trading account positions in terms of margin requirements. Unless, of course, placing these orders will lead to the closing of previously opened positions. Therefore, placing orders requires full margin support without taking into account those positions that you have open. I mean, if you want to open some vertical spread, let's say you first bought some call options with the near strike, sold the far strike, and continue to sell further. Let's say you don't have enough funds in your trading account to sell, because to place an order to sell the far strike option requires significant funds. Because of margin requirements, we have an insufficiency. This happens a lot. In such case, if you do not do everything at the same time, all at once, there are robots in the terminal for this purpose, AG robot combo, or the connector order robot in the AE desktop terminal, which allows you to trade several options and futures at the same time, i.e. combination. If you are not using this, you just need to sell in small quantities, a few contracts at a time, so you have enough margin requirements. And when you open position, the sold options, the bought options, the total margin requirements are summarized. Another small addition. Derivative exchanges with futures contracts always use margin requirements. They are simply deducted from the trading account. I mean, the funds on your account is a deposit for positions open, for margin requirements. Now let's get down to business. If we're talking about buying options, everything is very simple. For example, we buy put options of strike 25, let's say 1,000 options. Now we will find out how many margin requirements we will be required. The theoretical price of these options is 246. Look at the GM here, which is 245 or 246, roughly speaking. This is the value of the margin requirements. This is the margin guarantee. For clarity, let's open the chart. Here it is. The P&L chart of the options we bought has opened. The margin requirements are equal to the maximum risk of this position. What is the maximum risk? In this case, it is the maximum loss of the award of the options we bought. We paid $246 for them, assuming that we have 1,000 options, which is 1 Bitcoin. We have $246 of margin requirements blocked, which is the maximum loss we can incur in case of a complete devaluation of the purchased options. So it's simple. The margin requirements of the purchased options are equal to the award of those options. Very simple. It's the same with call options. You cannot lose more than you paid for the option. If we're talking about selling options, the situation is a bit more complicated. Let's go to the sell page. Let's try to sell the same put options. The margin requirements are now a completely different value. 3,759. How does the AE exchange calculate them? Possible estimated movement of the basic asset by the daily value is taken. That is, the margin requirements for the futures are taken. If it's 20%, it takes 20%. And several scenarios are calculated. The worst result is taken, the worst variant from the P&L chart. The volatility corridor is also used. A plus or minus value in volatility. What is our worst case scenario right now? If the price goes down and the volatility increases, how much loss will we get? The maximum amount of loss is the margin requirements on the sold options. Now I will try to sell another strangle and see what the situation will be there. Here, take a look at this strangle. The margin requirements have changed. The scenario grid calculates a wide variety of scenarios point by point. The worst case scenario is the maximum loss, the size of the margin requirements. Let's see what happens if we have a loss limit. We buy put options at strike 24,500 on the left and call options on the right. In this case, the maximum allowable loss is limited and therefore the margin requirements are reduced. A recalculation takes place and instead of $4,000, we see $280 only. If you want to drastically reduce the margin requirements on the sold options, you need to buy options with a longer strike. The amount of margin requirements is affected by the size of the delta. Let's look at this chart for an example. The margin requirements here are $400, maximum loss. If you're using delta hedging in this spread or just sold, let's just go with sold. Get rid of the bought options and we're left with just sold put options. If we now, for example, sell 200 futures at the same price, that will also affect margin requirements. In short, use delta hedging and reduce margin requirements. In this video lesson, I would also like to tell you about margin call. A margin call is nothing to be afraid of. A margin call is a letter in which the risk manager of an exchange tells you that you have insufficient funds on your account, according to margin requirements. Look above. This will happen when free is less than 0, that is, money is more than GM. So we have free funds going to minus. The risk manager will send a letter with a request to increase the amount of free funds to secure the position or to reduce the size of the position itself. In this case, the easiest thing to do is to either quickly replenish the balance. When working with cryptocurrencies, it can be done in seconds, or to reduce the position yourself. There is no liquidation here, as for example on Binance. There, if you exceed the margin requirements, they simply liquidate your account and all open positions automatically. There is no such thing on the AE exchange. There is more gentle risk management. Violation of margin requirements can, in the worst case, lead to the fact that traders of the exchange can undercut your positions. Traders forcibly close some positions in order to have free funds on the trading account to reduce the size of margin requirements. But please note, this is not the best way to reduce risk. For example, in this situation, if you are short in funds, you may have enough to buy new options and then the margin requirements will be reduced. Let's say we bought 24th strike put options. Then the margin requirements would be reduced by a factor of 5. It became 850. If you yourself do not have time to do something, and it will be done by outside trader making transactions to forcefully close part of the position, then he has no right to open a new position. But you can do it. Take into account that the forced closing trades use a tariff with a higher commission. Therefore, keep an eye on the margin requirements yourself. The purpose of margin call is to prevent you from maximizing your loss. It simply informs you that you have exceeded the requirements. It tells you that you're taking a risk and may lose funds. If the margin requirements are close to 100%, it is a signal to optimize your trading strategy to reduce risk. You can always make more preliminary calculations, build different scenarios, and predict what problems you will face. The AE terminal has all the tools for this. And that's all for now. Give me a like if you liked this lesson and found the information useful. If you have any question, please ask him in the comments. I will be happy to answer. If you're not subscribed to our channel, be sure to subscribe. Here is the maximum of useful information on stock options trading. I wish you all the best. Bye.